If you are thinking about a stock market crash or are worried about a bear market, or you just want some protection for your portfolio, in this video I will be looking at the data and showing whether and how you should be hedging. This is Mark from tradinginformed.com, and this video is the first video in a three-part series that will help your portfolio to thrive no matter what the markets do. In this first video, I will be looking at a simple hedging strategy and looking at whether this is any improvement on simple buy and hold. In the second video, I will be looking at some alternative ways to hedge your portfolio. And in the third video, I will be doing a walkthrough analysis and looking at how the hedging has performed at different points in time. In this series of videos, I'm going to be using the SPY Spider ETF, which tracks the performance of the S&P 500 index. And crucially, I'm going to be using it with dividends reinvested, which over any long-term time period is a large part of capital accumulation. In this first video, I said that I was going to compare buy and hold with a simple hedging strategy. If you look on the screen at the moment, you can see a spreadsheet showing the results of buy and hold of the SPY index from 1993 to 2018. So we have a time period of approximately 25 years. And you can see that over time, the compound annual growth rate has been 9.2%, which in turn corresponds to starting capital of $100,000 being increased to $910,000 with a net profit of $810,000. So you may wonder why, with capital increasing by 800%, why not stick to buy and hold? Many investors do. Well, there is a reason why you should at least consider hedging, and that is this number here, which is the maximum drawdown. And a maximum drawdown of 55% shows that absolute capital decreased by 55% from previous high, and we could see that previous high here in 2007 by 55% to a low in 2009. And the problem with drawdowns of 55% are psychologically, many people sell out at the wrong time, thinking that shares are going to nothing. They see the value of their portfolio evaporating, they sell out and they miss the subsequent market return. Many people need to close their portfolio at a specific time, for example, for retirement. If your portfolio within a year or two is suddenly worth 55% less, this will make a significant difference for the rest of your life. And so people look at hedging strategies. If you're thinking of riding out the drawdowns, one thing to consider is that they can last for a very long time. So from 2007, we didn't see those prices, even with dividends reinvested, back again until 2012. So we've got almost 5 years. The recovery from the dot-com crash was shallower but slower. So we had from 2000, we had to wait until somewhere in 2006 before we could see our portfolio having the same value. We've looked at the advantages and the disadvantages of a buy and hold strategy. So now I want to compare it to the hedged version. So if I click this button here, we can have a copy of these results on our strategy review tab. And I'm going to select from the drop down menu here, the moving average. And this strategy, as I've explained, is simply going to cash or neutralizing the portfolio when the closing price is below the moving average. And I've used a 200 period average. Again, I'm going to copy these results and we can directly compare them. Now, the first thing that immediately strikes me is we're getting lower profit. So if I put this as buy and hold and sell below the average, we can see that we're getting, over the 25-year time period, $250,000 less of profit. And this affects the compound annual growth rate from 9.2 down to 7.8%. Still fairly healthy, but significantly lower. And in fact, the maximum drawdown, which is what we are most focused on when it comes to hedging and bear markets and protecting ourselves in stock market crashes, the maximum drawdown is quite a lot lower. And one thing I always look at when the maximum drawdown is lower like this, I look at whether we can increase the leverage, whether or not we can take leverage positions and try to equalize the level of drawdown. So if I was to double the leverage here, we still have a maximum drawdown of lower than buy and hold, but our compound annual growth rate in this case is a lot higher and our net profit is a lot higher. So that's an interesting theoretical test. I hope you found this first video useful, in which we've looked at the very basics of a hedging strategy. We've compared it to buy and hold, and I think established that there is some benefit, historically speaking, of hedging a portfolio against very large market crashes. If you like the spreadsheet that is being shown on this video, click on the link on the screen at the moment or below this video, and you can find out some more information about that and how you could use it to test your own hedging strategies in your own markets. If you enjoyed this video, please hit the like button. Please remember to subscribe to this channel for lots more content like this about how to test your trading strategies, how to become a better trader. And for more information about trading the financial markets, go to www.tradeinformed.com.